Welcome to our comprehensive overview of debt financing versus equity financing. When it comes to financing your business, understanding the difference between these two fundamental approaches is crucial for making informed decisions about your company's future. In this video, we'll break down the key concepts behind debt financing and equity financing, exploring their respective costs, benefits, and potential drawbacks. From defining the terms to illustrating real-world examples, we'll guide you through the intricacies of each financing method, empowering you to choose the right strategy for your business. Whether you're a seasoned entrepreneur looking to optimize your capital structure or a budding startup navigating the complexities of fundraising, this video has something for everyone. We'll discuss how debt financing offers lower effective costs but presents fixed expenses and increased risk, while equity financing provides ownership stakes but may dilute your equity. Stay tuned till the end to gain a comprehensive understanding of debt and equity financing and discover why a combination of both may be the optimal choice for your business. And if you find this information valuable, don't forget to hit that subscribe button to stay updated with our latest content. Let's navigate the world of business financing together and unlock the potential for your company's success. Debt financing versus equity financing overview. When financing a company, the cost is the measurable expense of obtaining capital. Debt financing is the interest expense a company pays on its debt. Equity financing refers to the claim on earnings provided to shareholders for their ownership stake in the business. When financing a company, cost is the measurable expense of obtaining capital. With equity financing, the cost of capital refers to the claim on earnings provided to shareholders for their ownership stake in the business. Debt financing can usually be obtained at a lower effective cost, provided that a company is expected to perform well. Debt financing. When a company raises money for capital by selling debt instruments to investors, it is known as debt financing. In return for lending the money, the individuals or institutions become creditors and receive a promise that the principal and interest on the debt will be repaid on a regular schedule. Equity financing. Equity financing is raising capital by selling shares in a company. With equity financing comes an ownership interest for shareholders. Equity financing may range from a few $1,000s an entrepreneur raises from a private investor to an initial public offering, IPO, on a stock exchange running into the billions. Provided a company is expected to perform well, you can usually obtain debt financing at a lower effective cost. Debt financing. If your business needs $10,000 of financing, you can either take out a $10,000 loan at a 10% interest rate or sell a 25% stake in your business to your neighbor for $10,000. Suppose your business earns a $5,000 profit during the following year. If you took the loan of $10,000 at 10% interest, your interest expense or the cost of debt financing would be $1,000, leaving you with $4,000 in profit. Equity financing. Now, let's say that you used equity financing. You would have zero debt and as a result, no interest expense. However, you would keep only 75% of your profit, $3,750,000, and the other 25%, $250,000 your neighbor owns. The company profit would only be $3,750,000 or 75% x $5,000. From this example, you can see how less expensive it is, as the original shareholder of your company, to issue debt as opposed to equity. Taxes make the situation even better if you have had debt, since interest expense is deducted from earnings before income taxes are levied, acting as a tax shield. We have not gotten into taxes in this example for simplicity. Debt financing can also be a disadvantage. It presents a fixed expense. This will increase a company's risk. Suppose your company only earned $250,000 during the following year. With debt financing, you would still have the same $1,000 of interest to pay, leaving you with only $250,000 of profit, $250,000, $1,000. With equity, you again have no interest expense, but only keep 75% of your earnings, thus leaving you with $937,500 of profits, 75% x $1,250,000. Should you use debt financing or equity financing? In short, both. Although companies can make reasonable estimates, they are never sure what their earnings will amount to. The more uncertain their future earnings, the more risk is presented. As a result, companies in very stable industries with consistent cash flows generally use debt more than those in risky sectors or companies that are small and just beginning operations. New businesses with high uncertainty may have difficulty obtaining debt financing and often finance their operations primarily through equity. Integrity Financial Groups provides debt financing, equity financing, and debt equity financing. Debt financing will not dilute your equity. Debt equity financing offers lower rates and more flexible terms. Debt equity financing offers more flexibility than traditional or conventional box credit lenders. Contact us today for more information.